You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome to the Deep Dive. Today, we're really getting into a complex moment in global finance. We're looking at a recent market briefing, trying to untangle, the foreign exchange moves, shifts in commodities, trade tensions, and, geopolitics.
Yeah.
Our job is to connect these dots because, honestly, they're not separate issues, are they? They're all reacting to this core tension, growth slowing down, while security risks seem to be ramping up.
That's exactly the frame. This briefing really captures the market's mood, just as the U.S. is waking up, reacting mostly to some, frankly, disappointing economic news out of Europe and significant geopolitical friction pretty much everywhere. So for you listening, the key is piecing this all together. Understanding why the euro dipped involves understanding French PMIs and understanding gold's record price. Well, that takes us to Beijing. We're looking for those signals in all the noise.
Exactly. We're searching for what's really driving sentiment right now. Could be central banks making, quite bold moves, or even these very unusual airspace disruptions we saw, things you wouldn't normally expect. Okay, let's start with currencies then. The FX battlefield, as it were. The immediate trigger this morning was that purchasing managers' index data from Europe, the PMI. And it wasn't great news for the euro, was it?
No, not at all. The euro slipped pretty much straight away. And the main culprit was France. All three of their key measures, manufacturing, services, the composite, they all fell into contraction territory, below 50. That's a clear warning sign.
And the important thing about that French data, it's not just the number itself, right? It's the signal it sends. Germany, on the other hand, it was a bit more mixed.
Yeah, Germany saw manufacturing stay weak, still below that 50 mark, but services actually picked up a bit, rebounded. So you've got the Eurozone's two biggest economies kind of pulling in different directions.
Which must make the ECB's job incredibly difficult.
Oh, absolutely. And that uncertainty, that divergence, it pushed the USD pair back down towards the 1.17 level. Meanwhile, sterling, the pound, actually did even worse.
Worse? How so?
The UK flash PMIs, they missed expectations right across the board. Manufacturing, services, everything. That knocked the pound down immediately from its overnight high, which was around 1.3528, down into the 1.34s.
It's amazing how quickly these reports shift market expectations for central banks. Lower growth often means, maybe less chance of rate hikes, perhaps even cuts.
Exactly.
Which takes us neatly to Scandinavia, right? Because the Riksbank in Sweden actually did cut rates.
They did. A 25 basis point cut, taking their main policy rate down to 1.75%. But there are two really interesting points here. First, it wasn't unanimous. There was one dissenter wanting to hold rates, which signals, some internal debate.
Okay.
Second, their statement explicitly said rates would likely stay at this new 1.75% level for some time. So it's not just a cut. It's a signal they plan to hold steady at this lower level. Right. It feels like a blueprint.
But hold on. If they're cutting rates and saying they'll stay low for some time, isn't that risky? Given all the geopolitical stuff we mentioned, that often means higher inflation through energy or shipping costs. Is Sweden making itself vulnerable here?
That's $1 million question, isn't it? And the market's still figuring it out. We saw the Eurosec cross, the euro versus the Swedish krona, trade both ways initially.
Right.
Sort of bouncing around before drifting higher.
Yeah.
The market's weighing that domestic growth slowdown, which prompted the cut, against the risk of, importing inflation. It's definitely a bold move for a small, open economy like Sweden's.
Okay, let's shift over to Asia. We saw some definite action there to try and steady currencies, didn't we?
Right.
In Japan, the focus seems to be more domestic. Something about the LDP leadership race.
Yeah, that's right. The Liberal Democratic Party race matters because the leading candidates are talking about fiscal policy. Things like specific tax measures, but also sending signals about fiscal discipline.
And why does that impact the yen?
Because any major shift in government spending or borrowing plans could potentially force the Bank of Japan, the BOJ, to rethink its ultra-loose monetary policy eventually. We did see the dollar-yen pair dip briefly below its 50-day average, around 147.68.
Which is a technical level traders watch closely.
Exactly, a sort of psychological marker. It suggests maybe a short-term loss of momentum for the dollar against the yen, but it did stabilize afterwards.
And elsewhere, China and India were active too.
Yes, very much so. The People's Bank of China, the PBOC, set the official rate for the yuan, the USD CNY fix, a bit stronger than the market expected.
Subtle signal.
Very subtle, but clear. They set it at 7.1057 when the market was looking for something like 7.1066. It shows they're leaning against too much yuan weakness. And similarly, the Reserve Bank of India, the RBI, was reportedly selling dollars through state-owned banks.
To prop up the rupee.
To steady the rupee, yeah, after it hit some fresh lows. So both China and India are actively managing their currencies in the face of this broad dollar strength.
Right. Let's move on to commodities. Because if we connect that story of policy uncertainty and geopolitical risk, well, it leads us straight to gold. And gold is doing something pretty extraordinary.
It really is. Gold just kept climbing, hitting a new all-time high. A really quite stunning USD 3,780 per ounce.
Oh.
Now, we often see gold spike when there's immediate risk.
The classic flight to safety.
Exactly. But the briefing suggests this might be more than just that. It seems structural.
Okay, explain structural. That sounds important. What does that mean in this context?
Well, the key driver seems to be reports that China is actively positioning itself to become a custodian, a holder, for other countries' sovereign gold reserves, foreign government gold.
Wow.
If that's true and it gains traction, it fundamentally changes the whole demand story for gold. It's not just a hedge for individuals or funds anymore. It becomes a core long-term reserve asset for governments looking for alternatives, perhaps away from the dollar or other traditional reserves. That puts a whole new, potentially very large long-term bid under the market.
That completely reframes gold's role.
Okay, outside of gold, what about energy and industrial metals? The picture there was more mixed, you said.
Yeah, it was. Crude oil, both WTI and Brent, actually opened a bit weaker, but then they recovered during the morning.
What drove the recovery?
It seems like the market is trying to balance two things. On one side, you have lingering political pressure, especially around Russian oil purchases, which kind of keeps supply concerns bubbling under the surface.
Right.
But on the other hand, there haven't been any major new supply shocks recently, so oil seems a bit stuck, trading in fairly tight ranges. WTI was roughly between, say, $61.85 and $62.53 a barrel. Brent was between about $66.10 and $66.75.
And industrial metals, the stuff needed for building and manufacturing.
They were generally softer. Copper, for instance, slipped back below that big USD 10,000 per ton level on the LME. That probably reflects some of that weaker China sentiment we talked about earlier in the FX market.
Makes sense. But it's worth noting a longer-term story bubbling beneath the surface. In Chile, the development agency Corfo filed some important contract changes. These are aimed at paving the way for that big Codelco SQM lithium deal.
Ah, the lithium deal. Why is that significant again?
Because that partnership is seen as absolutely crucial for securing future lithium supply, which is essential for electric vehicles, batteries, the whole green transition, really. So it's a positive signal for future supply in a market that's expected to be very tight.
Got it. Okay, let's pivot now to trade policy. How does that connect back to, say, inflation, which the central banks are so focused on?
Well, this section really highlights that conflict we keep seeing. The briefing mentions comments from a major U.S. bank chief executive.
Yeah.
Basically saying tariffs could be, modestly inflationary.
Modestly inflationary.
Yeah, but the key uncertainty is for how long that impact might last. So it keeps inflation on the radar. Businesses might face higher costs, and central banks have to consider prices being pushed up by policy, not just by strong demand.
So trade friction potentially adding to inflation. But at the same time, we're getting different signals on the diplomatic front.
Exactly. While that trade friction exists, the briefing also notes signals, flagged by a senior U.S. lawmaker apparently, coming from both Washington and Beijing. Signals suggesting a desire to stabilize the relationship, improve communication.
So it's like two opposing forces the market has to weigh up.
Precisely. On one hand, you've got strategic competition leading to trade barriers and potential inflation. On the other, you have this diplomatic push to stop things escalating too far, which acts as a sort of stabilizing force. The market's constantly trying to figure out which one has the upper hand at any given moment.
Which brings us squarely to geopolitics, still a major driver of the overall risk mood. But let's dig into the consequences here, not just the headlines, starting with that really strange situation in Scandinavia.
Yeah, this was quite something. airspace disruptions because of drone sightings. In Scandinavia, a region we normally think of as very stable.
Highly unusual.
Extremely.
Yeah.
Oslo Airport had to close entirely for a while, and Copenhagen paused operations briefly. Things like airspace closures have immediate real economic impacts on travel and cargo.
And the language used was pretty strong too, wasn't it?
Very strong. Sweden's defense minister came out and basically said Sweden has the right to defend its airspace with force if necessary. That's powerful language. It signals just how seriously they're taking these incidents, whatever they were. It definitely raises the perceived risk level in that region.
Okay, moving from Scandinavia to strategic security, the U.S.-Russia nuclear treaty issue seems to be heating up.
Yes, the Kremlin is really pushing the point that time is running out on renewing or replacing the existing treaty. They're saying letting it lapse would be quite risky for international security overall. It just adds another layer of global uncertainty.
And meanwhile, lots of diplomatic activity around the UN General Assembly meetings, especially regarding the Middle East.
Absolutely. High-level meetings happening on the sidelines. We saw the EU and the E3, that's France, Germany, UK, meeting with Iran's foreign minister. And separately, Iran's top diplomat also met with the head of the IAEA, the International Atomic Energy Agency. That's obviously focused on the nuclear program compliance issues.
And specifically on the Gaza conflict.
Critically, yes. The briefing notes Washington is planning to present Arab leaders with some actual U.S. principles for ending the war. And it mentioned two specific elements which caught my eye.
What were they?
First, the idea of a potential multinational troop deployment to help facilitate an Israeli withdrawal. Second, a proposal for a specifically funded transition period. These are concrete ideas, not just vague calls for peace. If they were ever implemented, they'd have real implications for regional stability and, reconstruction efforts.
And we can't forget the ongoing risk to shipping lanes, right? That directly impacts trade.
Definitely not. The UK Maritime Authority reported another incident, this time about 120 nautical miles east of Aden. It's just a constant reminder that the risk to shipping in that vital Red Sea Gulf of Aden corridor remains high. That feeds directly into insurance costs and potential delays.
Finally, wrapping up the geopolitical scan, there was alignment in the Indo-Pacific.
Yes, a clear signal of unity. The foreign ministers from the U.S., South Korea, and Japan put out a joint statement. They specifically opposed what they termed unlawful maritime claims in the South China Sea.
Reinforcing freedom of navigation.
Exactly. It reinforces their shared commitment to the existing rules-based order for navigation, which is crucial for all the trade that flows through those waters. It's a stabilizing signal, aimed primarily at China, of course.
Okay, so let's try and pull these threads together for you, the listener. FX markets seem quite fragmented, very sensitive to local economic surprises, making life difficult for central banks.
Gold. Well, it looks like it's undergoing a fundamental shift, maybe becoming less of a pure risk hedge and more of a structural reserve asset. And underpinning all of this, the geopolitical mood feels quite tense, with these new unexpected risks popping up in places like Scandinavian airspace, areas that used to feel quite safe. It really forces everyone to recalibrate their risk assessment. For me, the most surprising or maybe revealing piece in this whole briefing was that Riksbank decision in Sweden.
Why specifically?
Because they essentially drew a line in the sand. They said, look, despite all this global friction and inflation risk, our domestic growth picture is weak enough that we're going to cut rates now and signal we'll hold them here for a while. It's a preemptive move based on their local outlook.
It is quite a statement. Okay, so we'll leave you with this final thought stemming directly from that Riksbank action. Given that explicit guidance rates likely staying at 1.75% for some time, what kind of precedent might this set? Could we see other smaller open economies facing similar dilemmas, caught between weak domestic growth and imported inflation? Could they follow Sweden's lead? If Sweden's the first major one to cut and guide a long hold, who might be next?
Something to ponder.
Definitely something to think about until our next deep dive.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.